wasn't easy. I didn't actually have an answer for what should I be doing. But a couple of months later, I came up with not that I knew it was right, but it was like, I think the structure of technology, being surrounded by it here and investing in some of it at that point, I thought the structure of technology, which does not mean revert, right? And it's like a very fast changing thing with a lot of nonlinear outcomes. I thought the structure of technology was favoring the highest quality human capital, which is essentially the opposite of commodity. In 2011, after being invested for 10 years in 10 years in energy and 8 years in mining, gold I've been invested in for 9 years, I had this weird experience where the three commodities I was long all went up, but the equities associated with those commodities all were down. Like gold was up 17% in 2011, and the gold equities were down 17%. Just didn't make any sense. And the top, I remember, was, I think Osama bin Laden was killed, I believe. And I also remember reading like a Wine Spectator, I think the top in Bordeaux prices was April 2011. But what happened was there was a top in sort of things associated with growth, and I guess you could say there was a risk that was removed. But the spot commodity actually acted quite differently from the equities, and the equities were discounting the future, or perceptions of the future. It was almost like Chinese were sellers in 2011 or something, but the market didn't know. And anyway, but after 10 years and evaluating post-crisis what the macro situation was and how much growth could we really get out of the world, Europe was a challenge. I just came to the conclusion like we weren't going to get enough growth in the world, not enough to support it, and actually I should trust the equities and not the commodities that I was long. If you're long a commodity equity, you're really long the commodity equity. You think you're long the commodity, but you're really long the pricing and liquidity in the equities. And it was very difficult. I sold every position I had except for two. One was a refiner, and one was a specialty chemical company that got acquired a few years later. But I just got out, and it was a real about face, and my team thought I was kind of crazy. And as I think it was partly like a right brain moment. I didn't know that I was right, but I thought there was a good chance I could be, and I had to reevaluate the world. And so that's what I did. And by beginning of 2012, I came up with a different conception of how I should be oriented, because I'm always looking for what is going to be different 5 years from now. It's just the way it works. It's like the markets are totally repriced 5 years later, and I thought this was the end of an era. It's 10 years for me of being invested in commodities, and so that's where I got to a belief that human capital was what one should be long, and I was just the opposite of commodity.
It's actually, it's difficult to convey to people how hard that is for a professional investor, particularly somebody who had the industry footprint as yourself, right? Your clients had heard for years about how commodities were, underappreciated investment, that the dollar was a problem, that China was going to grow to the moon, et cetera. And as you mentioned, your team probably resisted quite strongly. You'd probably built a team that had mining experts and very little in the way of human capital. And so that's a remarkable change. And it also creates conditions in which, paradoxically, from an institutional standpoint, it creates a tremendous amount of uncertainty. You must have received not just pushback from your team, but your investors probably said quite sharply, "What are you doing?" Right? Gold is at all-time highs, and oil is back above $100 a barrel. And these stocks are incredibly cheap if you think of them as investing in the commodities. Am I incorrect in that assumption, or was that something you really faced?
It's true, but this is a left brain and a right brain activity. Your right brain is spotting patterns, right, and using intuition, and sort of animal senses, and your left brain is logic and, you know, the lawyer and the accountant and I find that I think I have a good mix of the two, and I find that there are too many people in investing in finance who are left brain focused and can miss, you know, signals. But I don't know. It wasn't easy. I didn't actually have an answer for what should I be doing. But a couple of months later, I came up with not that I knew it was right, but it was like, I think the structure of technology and being surrounded by it here and investing in some of it at that point, I thought the structure of technology, which does not mean revert, right? And it's like a very fast changing thing with a lot of nonlinear outcomes. I thought the structure of technology was favoring the highest quality human capital, which is essentially the opposite of commodity. You know, the opposite of lowest cost, you know, available commodity. And I by thinking about that and being around it here, and knowing that the cost of creating technology was just getting cheaper and cheaper, I came to a conception that maybe the surprise is how valuable. How much more valuable the A students in the class is what I said. That really you should just belong the A students in the class and short the rest of the class. It doesn't matter. Whereas commodities, you know, you're looking for that, you know, something needed that has a very low cost and is, you know, cheap to transfer, but doesn't actually require, you know, tremendous, you know, ongoing sophistication. And so that was like a set of ideas and thoughts that had sort of evolved and emerged. And then I realized by selling, I was, you know, making way for it. The biggest problem was that I ran a diverse sectors and had many different teams, and I didn't decide to, you know, abandon the mining team and abandon the energy team. Energy peaked last in, you know, 2014. But anyway, but I do know that markets, you know, every 5 years look completely different than they did 5 years before, and security prices move so much that it's always, you know, it's this new recognition of change. And I focus on change. That's the thing that, you know, is dependable, but it happens in different ways in different areas. And it wasn't until beginning of 2013 that growth really took off, and that's when tech really started to do better. I'd say it wasn't so clear that tech was absolutely the thing to do, I think.
Well, it definitely wasn't. And you mentioned something that I think very few people are able to articulate as well as you just did, which is that technology does not mean reverting, right? Mm-hmm. And so you and I both came of age, you know, bracketed on either side by a technology bubble, right? So mm-hmm. the 96 to 2000 time period, you and I both looked at that.
Makes you think it's mean reverting, but that was
yeah. I mean, that's, you know, the assumption was that, you know, okay, well, valuation is what matters, and if we look at things like you know, mining companies, they were deeply neglected, and therefore they are value, right?
And they were, but mainly because of 20 years since the top, and China was coming, and people didn't know. That's what ended up happening, and you know, the dollar got cheaper, and there's also a place to avoid the carnage of
the tech crash,
the 2000s.
Yeah, no, I think that's absolutely correct, and I think that's, you know, what we've paradoxically seen is that value has actually now had its longest run of underperformance, mm-hmm. right? It had a very brief window, basically from, you know, 2000 through 2006, in which it made up a lot of lost ground. But if you actually look at that approach to investing, it's been an unmitigated disaster for, you know, the past 30 years.
Yeah.
And it always sounds far more rational, right? I mean, who wouldn't be pro value, right? I mean, who wants to be the momentum guy? That makes you sound like a moron. But really, there's something deeply insightful about that idea that you know, mean reversion is kind of silly, and the idea that energy, as expressed by petroleum or other sources, is going to be as large of a component of our purchasing basket as it was historically. Mm-hmm. Is very hard for people who made a lot of money and who mm-hmm. built up a notable mm-hmm. Reputation on that basis. So you mentioned you made this transition and you didn't abandon your teams, your mining team, et cetera. And you were 100% right, but you know, what challenges did that create for you organizationally? I mean, How do you think about that transition, that decision not to just wipe the board and move on in a different direction?
Well, part of it was you can always be short things that you were long, but you do also need your team to believe in these things. And again, I had this idea that was potentially a big transition. And so I started to do that, be short commodities instead of long, and see them as a hedge to things with growth and more human capital. But running a diverse funds where you want the vol to be relatively low, it's hard to and you have limits on how much we had limits on how much we could put in any one sector. So I actually had risk-based imposed limits on where we could put capital, and I would have been better off, retrospectively, saying this is my belief, and when I validate this hypothesis, I'm just going to go focus on this and forget the other stuff. I believe that's the right thing now, because I think, and what I've noticed for a long time is, although the economic growth may be okay, and right now it's good, but I don't expect it to be that great. The change is actually increasing regardless of economic growth, because structurally, as tech advances, it releases new information. In fact, the new information growth is tremendous, and that new information therefore illuminates, creates realities and recognitions that you didn't have before, and so it changes people's behaviors. So I think now I would have been better off saying I'm going to go with when I really got to believe this was the case in 2012. I'm just going to focus on this, because that would increase my chances of understanding it and getting a return from it. But it would have added to my risk level, and it would have been a meaningful change. And so what I did personally was essentially start investing much more heavily with my own capital to test this hypothesis. And I had a belief that San Francisco real estate was going to do really, really well. I was the biggest bull that I knew, because I thought human capital is what really meant the most, and the density of human capital. Human capital basically attracts other human capital. And I thought, so I'm going to test this with my own capital and not diversify, and get more feedback, more information, and see how it went. And so it did go well. I didn't put a huge amount of time into it, but I tested it with my human capital, my own personal capital. And essentially what I'm doing now is essentially saying, I am not going to allow the drag of things that are not interesting or that fit my hypothesis slow me down. I'm actually going to focus my attention, which is limited like everyone's, on what I think, the hypothesis of what I think is going to be the next 5 years. And so I learned I actually would have been better off abandoning more and betting on this belief, or at least working as hard as I could to validate a hypothesis. And even though I know people want to put you in a box, they want you to do something repeatable, they don't really want you to diverge from that. But markets change. They learn, they reprice, and then the world is actually a different place 5 years later, 10 years later. And tech globalization's created a different place. Tech's a different place. The thing that absolutely threw me, out of this was central banking. Central banking essentially created a non-mean reverting supply of liquidity, which you could say removed, a certain prudency of those who are looking for changes of liquidity that create changes of price, right? And desire to be aggressive or conservative as a mean reverting thing, and allowed, in a way, this progress towards this, ever increasing tech-enabled future to happen even faster. And so the limitations, the human limitations of not wanting to prevent that, made me think I'm not going to subject my career and capital, investors' capital, to getting that behavior correct, when this trend in tech is only getting more powerful, right? And I find it now hard to have a discussion about almost anything without including technology as part of it.